Well, global bonds are headed for their third straight month of gains. Joining us to discuss the market drivers is James Dutkiewicz. He's Chief Investment Strategist at Sentry. James, great to have you here. So what is supporting gains in the global bond market right now?
Well, I think there's a few factors. One is there was obviously a backup in yields globally after the U.S. elections. There was a great amount of angst in the bond market that Mr. Trump was going to deliver some sort of a deficit-financed fiscal stimulus and that the rate structure was way offside. And while there is some truth that rates were probably too low going into the election for any kind of a fiscal stimulus, the bond markets have figured out that it's a lot more gridlock in Washington than might have appeared back in December and January. So bonds have kind of rallied a little bit after a significant sell-off in the first part of the post-election time frame.
Let's take a look at 10-year treasuries and German bunds. We're seeing the spread grow there. And I'm wondering, with the ECB looking like it's going to stick with looser monetary policy going forward, looking at more divergence with the U.S., how long do you see that lasting?
Well, the ECB is in a bit of a tough spot because cyclically they've gotten a bit of a boost from their QE and from some other things. So their economic performance is reasonably good. And they have the QE ongoing. Now they have tapered from 80 billion euros to 60 billion euros. I wouldn't be surprised if by the summer after the French elections, if that 60 billion euros becomes 40 or 30 billion euros. And ultimately by maybe 2018, they're not buying any paper at all. The Bundesbank, who still is the loudest voice, the German central bank within the ECB, obviously is not that comfortable given overall growth and inflation data in Europe to QE. And so would Draghi accommodate the Bundesbank by laying out a strategy where the QE is tapered off into 2018? That makes sense. But they're a long way away from raising interest rates. Not me or one of the gentlemen there in Europe suggested last week that they could be looking to move rates. I think the probability of them raising rates while they're still doing QE is quite low. No other central bank, as they unwinded QE, immediately started tightening. There's a significant gap between one and then the other. So I think the interest rate differential in the short end of the curve is still going to be U.S. rates higher, ECB keeping rates relatively low.
And in fact, we saw the U.S. 10-year rise above 2.4% today. Yields. Why is it, though, that the 10-year continues to trade in that 2.3 to 2.6 range? Why can't it break out?
It's really straightforward. It's just math. You know, the beauty of government bond curves if you don't have any credit risk, i.e., there's no risk or very little risk that the government's not going to pay you back, then it's just math. And the math is where are short-term rates vis-a-vis the central bank overnight rate? Where do you think inflation is going? How much central bank movement do you think there's going to be? And are you being rewarded enough to be in a 5-year bond versus a 3-year bond, or a 7-year bond versus a 5-year bond, or a 10-year bond versus a 7-year bond? So as you go out the yield curve, it's nothing but a series of forward calculations, okay? And it's just pure math. Well, so when we're between 230 and 260 in the U.S., by our calculations, you have somewhere between 4 to 6 Fed tightenings in 2017 and 2018 priced in. So given that's the teeter-totter, are we going to get more than 5 or 6 or less than 3 or 4? It's sort of a point of fair value.
Well, on the 260 that you mentioned, Bill Gross has said that that's the signal that we have now seen the end of the secular bond.
It's great that Bill Gross said that. I mean, you know, I think my
him?
daughter, she's 11. If I put the 10-year bond chart up, she'd see 260 is pretty important.
So you don't think so?
No, it is important because it is an inflection point in a technical analysis, right? And so I do think that there's a great risk that if you break 260 with a series of strong data in the U.S. and/or a more aggressive Fed dialogue that really does suggest they might go 3 more times in 2017, you could see the 260 give way, and it would probably move up towards 3%. Round numbers, bond market like round numbers.
And are you seeing those signals now that the Fed will get more aggressive?
No, I mean, there's some people talking within the Fed, but don't forget, I would say there's 2 things about the Fed that is relevant. One is we think that there's been a change in their reaction function from December of last year to the March meeting, because the data has been uneven. You can talk about soft data versus hard data. You can talk about survey data versus actual activity in the economy. I mean, the fourth quarter just came in barely above 2%. First quarter in the U.S. is probably tracking below 2%. So why did the Federal Reserve, when it wasn't priced in for them to go in March, in December or January of this year, why did they go in March when the data doesn't really drive it? something has probably changed within the Fed's reaction function. So this is impossible to know exactly what's driving it. We think at our shop that it's really just a function of a cumulative nature of low unemployment. The economy continues to do okay. Inflation pressures are building up slowly, and the Fed said, hey, we just want to get ahead of this a little bit and make sure that we get our 3 tightenings in 2017.